Why do billionaires pay less tax than you? It's not a conspiracy, it's the system working as designed. The ultra-wealthy use legal strategies and a complex tax code to minimize what they owe, while most people pay high rates on every paycheck. Ordinary income, your wages, is taxed at the highest rates with deductions taken out automatically. But billionaires build wealth through assets like stocks and real estate, which are taxed differently and often at lower rates. Over decades, laws and loopholes have been crafted to benefit those with resources, perfectly legally. To understand how, let's look at the key tools: capital gains, depreciation, and strategic borrowing. What is the cornerstone of the rich's tax strategy? It's a concept that allows wealth to accumulate and grow with minimal tax implications, a key element in preserving and expanding their fortunes. Capital gains. The engine that drives wealth accumulation for those who understand how to leverage it. When assets like stocks, real estate, or even art go up in value, that's a capital gain. It represents the increase in worth of an investment over time. But you owe zero tax until you sell. This is the crucial difference. The gain is unrealized and therefore untaxed until the asset is disposed of. The wealthy can watch their fortunes grow for years, even decades, tax-free, as their investments appreciate in value. This allows for significant compounding of wealth. While wage earners pay taxes every paycheck on every dollar earned, leaving less available for investment and growth. When they finally sell, often after years of appreciation, the profit is taxed at a much lower rate than ordinary income. 20% for long-term capital gains for assets held over a year, compared to up to 37% for ordinary income, like salaries and wages. This means the rich pay less tax as a percentage of their overall income, even when they cash out significant portions of their investments. The system rewards them for holding on to assets, incentivizing long-term investment and letting wealth compound across generations, creating lasting legacies. Why sell and trigger taxes? Many don't see the need, especially if the assets are performing well and generating income. They just keep holding, passing the assets down to their heirs, building dynastic wealth that spans generations. The result, the rich get richer, taxed less on their accumulated wealth, while workers pay more of their income in taxes, limiting their ability to build wealth and achieve financial security. It's a system that favors spectators, those who own the assets, over players, those who are actively working for a wage. Real estate is another tax superpower for the wealthy, thanks to depreciation. The tax code lets property owners deduct a loss in value each year, even if the building's market value is rising. Example, buy a $27.5 million apartment building, claim $1 million in depreciation yearly, and wipe out rental income on paper. The result? Collect rent in cash, but report zero taxable profit. These paper losses can even offset other income, shielding more wealth from taxes. When the property is sold, taxes are due, but often at the lower capital gains rate. And with a 1031 exchange, they can defer those taxes by rolling profits into a new property, repeating the cycle. It's financial alchemy, turning real gains into tax-deductible losses. So how do the rich fund their lifestyles without selling assets and triggering taxes? Enter, borrow, buy, die. Step 1, borrow. Use assets as collateral for huge low-interest loans. Loans aren't income, so no tax. Step 2, buy. Use the loan money to live large or invest more while assets keep growing tax-free. Step 3, die. When they pass away, heirs inherit assets at current market value, erasing decades of capital gains taxes. The step-up in basis wipes out the tax bill, letting wealth transfer tax-free. The result, the rich live off borrowed money, never sell, and their heirs start fresh. It's the ultimate loophole, turning paper wealth into spendable cash, tax-free. The tax liability vanished at death. The cycle continues generation after generation. When U.S. tax laws aren't friendly enough, the wealthy go global, using offshore tax havens. Places like the Cayman Islands or Switzerland offer minimal or zero taxes for foreign money. The rich set up shell companies in these havens, transferring assets and profits out of reach of the IRS. Profits sit offshore untaxed until brought home, if ever. Multinational corporations use similar tricks, shifting profits to low-tax countries through internal transactions. Despite recent crackdowns, secrecy laws make it hard for authorities to track the money. The result, trillions sit in tax-deferred limbo, compounding far from public coffers. It's a parallel financial system for those who can afford it. Charitable giving isn't just about generosity and goodwill. It's also a powerful tax tool, especially for the wealthy, allowing them to strategically manage their assets. It's a sophisticated approach to wealth management that intertwines philanthropy with financial planning. Consider this: you donate a painting, originally bought for $1 million, but now appraised and worth $20 million, to a reputable museum. By doing so, you get a substantial $20 million tax deduction, significantly reducing your overall tax burden, and completely avoid paying any capital gains tax on the appreciated value of the artwork. It's a double benefit. The same strategic advantage applies to appreciated stock holdings. You can donate those shares directly to a qualified charity, deduct the full fair market value of the stock from your income, and completely skip paying any tax on the capital gains you would have realized if you sold the stock. Private foundations take this concept even further, offering an even greater degree of control and tax benefits. You can donate a wide range of assets to your own private foundation, receive an immediate tax deduction for the contribution, and crucially, retain significant control over exactly how the money is ultimately spent and distributed. This control sometimes extends to paying salaries and benefits to family members who are involved in managing the foundation. In essence, the government is subsidizing this form of generosity through significant tax breaks. This allows the wealthy to effectively shelter their wealth from taxation, all while maintaining a public image of philanthropy and social responsibility. While foundations are legally required to give away a certain percentage of their assets each year to maintain their tax-exempt status, they still represent a powerful and enduring way for wealthy individuals and families to avoid significant taxes, maintain control over their assets, and direct their charitable giving according to their own specific priorities. It's undeniably a win-win situation for the donors themselves, but it inevitably raises fundamental questions about fairness and equity within the tax system. In practice, the line separating genuine charitable intent from sophisticated tax avoidance strategies can often become quite blurry and difficult to discern. After all this, it's clear: the tax system isn't broken, it's working exactly as designed. These aren't glitches, they're features built into the code by those with influence. The system rewards capital, not labor, and creates a two-tiered tax reality. The wealthy aren't breaking the law, they're playing by rules they helped write. The complexity keeps most people out, while those with resources find every advantage. Understanding these mechanisms is the first step to changing them. If you want a fairer system, you have to know how the game is played and who wrote the rules.